Thank you very much. I'm Dara Keogh. I'm Deputy President of Dublin City University, and it's my great pleasure to move right along into the next session. We've sacrificed a tea break, we've sacrificed coffee, but we're dying to hear the next presentation. It's been a wonderful afternoon with challenges in so many ways. That the last panel discussion was riveting for an early modern historian like myself, I suppose. We've seen Brexits in the past, in the 16th century, and then again in the end of the 18th century into the 19th century, and with Trafalgar and all of that. So it's wonderful now to, I suppose, to return to the crux of the matter. And I anticipated again in the questions that we've seen so far that we're dying to hear what Eb has to say, both from his, I suppose, position within the central bank, but also I think that the perspective that it brings himself from his own experience in the UK in that context. So we're really looking forward to hear what you have to say. But before I do that, I'd just like to thank our partners today. I'd like to thank Brian O'Gorman and his colleagues here in Arthur Cox specifically for their sponsorship of the Brexit Institute at Dublin City University. I'd like to thank my colleague Federico Fabrini, who arrived with us in DCU at a providential time. This was what the Italians called fortuna to DCU just as Brexit began. And the momentum that we have seen, and we're particularly grateful to people like yourselves who've come along and added to the vibrancy of the debate. So I'm delighted on behalf of the DCU Brexit Institute to introduce Ed Sibley this afternoon. Again, Deputy Governor of the Central Bank of Ireland, an ex officio member of the Central Bank Commission, and significantly a member of the Supervisory Board of the European Central Bank. And again, as I said at the beginning, I suppose from his own personal perspective, his experience working in the UK Financial Services Authority in the past. So we're delighted to hear what you have to say. So thank you very much.
Thank you for that very kind introduction, and thank you to DCU for the invite today, and thank you to Arthur Cox for organising. I was really interested, I was delighted to be able to make the panel discussion today. I was very interested in the discussion, and if we were to play, I guess, Brexit regulatory bingo, then passporting, cliff edge, equivalence, transition, regulatory arbitrage, engagement, substance, sadness, actually, which I absolutely share, and asymmetry pretty much cover my speech, or so my remarks. So I feel as though my job is almost done before I start. But no, it's very, very interesting, and I hope to be able to actually provide a little bit of insight into some of those topics as I speak. Just in terms of my remarks, there is a full speech that's going up on the website, probably up there now, thanks to Katie in the room here. And I'm sure you'll go straight from this room and look it up and read it in detail. But it will have a bit more detail to what I cover in the next half an hour or so, and also will be fully referenced. I would congratulate DCU for the foresight of setting up the Brexit Institute. I think it is very important that there are different voices and different fora to have this type of discussion, where we can have academics, industry representation, regulators, media, other interested parties actually joining in the debate and adding to the knowledge and questioning of what's happening with such an important topic. So I think it is commendable. In terms of my remarks, I'll give a brief overview as to kind of the key aspects of Brexit, how we're looking at it from within the bank, and then I'll focus on those areas. So I'll talk a bit about the impact on the Irish economy as we see it within the central bank. I'll talk about the impact on the financial services sector as a whole, and then drill into the impact on the financial services firms. I'll talk a little bit about the regulatory framework, and then I'll conclude with some of the key messages that I think are important to deliver today. As has been touched on already, it's very unpredictable where we are today. It is very challenging for firms, for politicians, for ourselves as regulators to know quite what is going to happen. But I think it is clear that it is momentous. It is one of those events that is once in a generation that's going to impact in many profound ways. It's also very clear to me that there is a huge amount of asymmetries associated with Brexit. There are asymmetries in terms of the impact that Brexit will have. Clearly and obviously, the UK is going to be massively impacted by Brexit. Ireland comes just behind that in terms of impact and how it's going to be affected. But if you go beyond that into other parts of the EU, and I see a lot of this through my constant travel within the EU, it's actually a lot lower down the agenda than people in the UK and Ireland actually think it is, and a lot of people's thoughts. There's asymmetries there. Asymmetries, therefore, in terms of interest, asymmetries in terms of incentives, and asymmetries in terms of the decisions and impacts of those decisions that we see. And that I'll touch on as I go through my remarks, because it does matter. It is impactful. Those asymmetries are impactful. And a really strong case in point of that is the transition agreement. So the transition agreement, which is absolutely welcome, I very much welcome it from a regulatory perspective and also from a personal perspective. But it means different things. It means different things from an EU perspective to what it means from a UK perspective. And those asymmetries matter in terms of what we do about that and how we can react to it. And I'll talk more about that. The most important thing for our perspective in terms of the transition is there is still plausible downside risk. And so we must continue to prepare for that plausible downside risk. And I'll talk again about that in a bit of detail. Just to give a little bit of context of our overall approach within the bank, it's very much anchored, certainly from a prudential regulation perspective, with our vision for the financial services sector in Ireland, that it is well regulated, well managed, and it serves the needs of the economy here in Ireland and its customers in a sustainable way over the long term. But we also, because we have an internationally active and increasingly internationally active financial services sector, we operate within a European regulatory framework, an ecosystem within the EU. And we have international and European responsibilities, so that also drives the work that we do. And ourselves, we've been very focused on ensuring that we understand as best we can the impacts and the risks associated with Brexit, engaging with firms to make sure that they are thinking about it and making sure that they understand and are reacting to this themselves, and engaging within the European forums. Again, that was touched on earlier, and I'll get into a little bit of detail on that. So that covers things from an overview perspective. If I turn now to the economic impacts, there's a lot of work done by ourselves, by the likes of the ESRI and other bodies around these potential impacts. So dangerous to be too predictive about them, but what we can talk about is what we know today. So if we think about Ireland, we talked already today about 1973 and when Ireland joined. At that point, there was a very large dependency in Ireland on trade with the UK. That has obviously and very significantly reduced since that point, but it's still significant direct trade with the UK. So from a 13% of goods and 16% of services exported from Ireland are to the UK. And that trade actually is concentrated in different sectors. So that are potentially or actually important from a regional perspective, and also important from an employment perspective, and important in certain sectors such as the kind of broader SME sector. Those are all likely to be impacted in a negative way by Brexit. And so the impacts of Brexit are likely to be somewhat uneven in Ireland because of the sectoral concentrations. One thing that is clear, abundantly clear from Brexit, is that access to UK markets and from UK markets will be more challenged, will be more difficult. There'll be frictions in them. That is inevitably going to impact on trade. If WTO rules, which I'm sure we all hope won't happen, but if that is the foundation of trade, then we're talking about very significant tariffs, up to 30% in the agri-food industry. And even in a free trade, even with a free trade agreement, even if it's an ambitious one, as it has been described, there will be frictions involved in that. The logistics, customs, and the like are all likely to inhibit or add costs to trade. It's also going to have impacts, not just from a pure economics perspective, but the reduction in choice and reduction in imports, and a reduction actually for consumers, and also from a disruption in terms of business lines undertaken in Ireland. One of the things that I didn't think about actually until at the start when the Brexit vote, and I didn't actually realise, is physically how much of Irish trade travels through the UK. So not the trade of the exports to the UK, but actually physically, by weight, 53% of Ireland's non-UK exports travel through the UK. So any frictions in that trade is obviously going to be negative from an Irish perspective. There's also very strong linkages, partly for these reasons, with the UK economy, and what has traditionally been shown as that what's bad for the UK economy is bad for the Irish economy. And there is strong correlation from a growth perspective. So any percentage point growth impacts within associated or arising from Brexit from damage to the UK economy is going to impact on the Irish economy. And there's also then a very strong interlinkage between the UK financial system and the Irish financial system. And the Irish financial system, of course, has direct exposures to Ireland and some of these negative consequences as well. So there's risks to the Irish financial system from a macro perspective. There's risks to the Irish financial system from its exposure to the UK. And there's also structural shocks that are going to impact on the Irish financial system as well. And again, some of those have been touched on already, and I'll expand on them a little more. So this then brings me to the financial system itself. If we think about globalization and what's happened in the financial system, and more broadly than that, over the last 20, 30 years and longer, the interlinkages from a global perspective, from a European perspective, and between the UK and Ireland from a financial system perspective are very significant. And what we're talking about here is taking a very significant disruption to those linkages, and the assumptions and basic plumbing associated with those linkages is changing. It will change. It is changing significantly. That brings in very significant cliff edge risks. Now, in a hard, chaotic Brexit, we'll see those cliff edge risks crystallize in pretty short order. But I think, as Niamh said earlier, even if we have a transition, it doesn't mean those risks go away. It just means we've probably got longer to try and mitigate them. And again, I'll go into some of those in a bit more detail. What I was going to talk about now was passporting, and which is quite a dry topic, but it's a really important one. But I'm assuming from the discussion on the panel that it was a very educated room here, that I don't need to explain the intricacies of passporting and why it's important. But just to say, and it's basically through freedom of services and freedom of establishment, it allows UK and Gibraltar firms to provide services into the EU without a physical presence necessarily, and vice versa. It is almost certain, I cannot see how that is going to survive past any transition. And that's a very, very material change that we all need to be prepared for and work on. And it affects different sectors in different ways. The insurance industry here and the funds industry here are probably the two sectors that are most impacted. And I'll turn to the individual sectors now. From a banking perspective, the domestic banks structurally don't have too much of a problem. There are branches from the Irish banks into the UK, but they're not really material in terms of ongoing business. So it's more an exposure to the macro shocks, both here and the UK. One of the consequences of the crisis here has been an increased concentration in terms of business models, very much focused on Ireland, with a degree of diversification into the UK. So a very strong exposure to the UK and to Brexit, but not so much of a structural issue. But what we will see and are seeing, and again it was referenced earlier, is a significant change in the international banking system here, with a very significant increase in the size, the nature, and the complexity of the system here. From an insurance perspective, I'll give you some figures here. The insurance industry in Ireland is an international industry, both inward and outward of Ireland. About approximately 1.8 billion of non-life premiums per year are written. In Ireland are written by UK or Gibraltar-based firms. That's a 2.5 billion figure for life insurance policy. That compares with a total figure for total written premium by Irish authorised firms of 17 billion. So you can see sort of start talking about billions, it's a significant amount of money, but it's also pretty significant in terms of the overall size of the sector. If we then add in and think about reinsurance and outsourcing and other connections with the UK system, it becomes even more significant. From a funds perspective, the UK fund managers may lose their rights to manage Irish authorised funds if passporting is no longer open to them. Perhaps more materially, from a post-crisis reform perspective, a lot of work has been done to increase the transparency of the system within Europe, particularly from a securities and derivatives markets perspective. That's been delivered through changing the infrastructure, and a lot of that infrastructure sits in London. So to give you an example, the London Clearing House, which is one of the world's largest central counterparties, clears 95% of over-the-counter interest rate swaps. That can be as much as $1 trillion notional per day. There's no firm or organisation or bit of infrastructure that can replace that. Post-Brexit, if that is taken off the pitch to a large extent, and there's some complexity in that which I won't get into, that will have some pretty significant impacts from a financial stability perspective, some pretty significant impacts from product availability, and including things like having, long-term fixed rate lending. There's also, from an Irish perspective, to look at the settlements of equity securities traded on the Irish Stock Exchange. That's done through an Irish central securities depository, a UK central securities depository. In a hard Brexit, with no mitigant to that, it's a very significant issue for equities trading in Ireland. So there are some very significant issues from a funds perspective. We talked, the panel discussed contract continuity. That's a very significant problem from an insurance perspective as well as derivatives. Can insurance firms who are branching either into Ireland or into the UK from Ireland, can they continue to provide cover? Can they continue to collect premiums? Can they negotiate and settle claims? And that's not just an issue around the shorter dated non-life policies that are being written today. It's actually we have that issue now today, typically in the kind of longer dated insurance contracts, such as life cover and the like. And so very significant problems that need to be mitigated. We're obviously in the bank working very hard to try and make sure that's done. And in fairness, those large players will be working very actively on their plans to address these problems. And talk a little bit more about transition in a second. But I do think there is likely to be an issue, and if we go back to insurance, where those products that might be a bit niche, or those markets that aren't particularly deep, which may be an add-on to the service that's been provided by a UK firm, the costs associated with the hassle associated with seeking authorization in Ireland simply isn't economic. And so we will definitely see, I think, in some of those areas, a reduction in competition. We may well see a reduction, a kind of loss altogether of certain product lines, which would obviously be problematic. So I've talked kind of at a macro level about the Irish economy, at a kind of relatively macro level about some of the sectors and some of the financial services sectors. I'll talk now a little bit about how we're looking at firms. As I've touched on already, and it really does drive our work. The vision that we have for the financial services sector is it's well managed, well regulated, and it does serve the needs of the economy and its customers. And I translate that in terms of in my thinking into 4 objectives. So does a firm have sufficient financial resources, including under a plausible stress? Does it have a business model that's going to make money? So is it a sustainable business model over the long term? Does it have appropriate governance arrangements, appropriate cultures, appropriate risk management, effective control frameworks in place? And can it recover it if it gets into difficulty? And if it not, can we resolve it without recourse to the taxpayer? So those are the 4 things that I think about from a prudential regulation perspective. And each of those 4 things, and consequently the overarching vision that we have for the sector, are put at risk and impacted by Brexit. So that really does inform our thinking. And it has informed our thinking since before the referendum about how we need to respond to Brexit. And it informs our day-to-day interaction and our longer-term supervisory strategies for engaging with those firms that are already operating in Ireland. It also informs our thinking around the new firms that are coming, or those firms that are planning to materially change their arrangements. And Robert talked about this earlier. So we have absolutely prioritised engagement. There is most definitely an acceptance that there is a need for firms to change their arrangements. And I'll come back to the equivalence point in a second, but there is an acceptance in the industry more broadly that organisationally they need to change. They can't, certainly the bigger firms, cannot rely on an equivalence regime to enable them to continue to write business across the EU. This is where another asymmetry comes in. This is not a wanted cost. There's no business benefit really in terms of what's happening as a result of Brexit. It's unsought, hoped against, and not only in terms of the costs of setup, so the costs of finding new premises, the costs of relocating staff, the costs of going through the authorization process, paying advisors and so on. But an ongoing cost, the cost of friction, the cost of disrupting global flows of across firms, costs of having to put capital in certain locations when actually it was flowing more readily across groups. So very much from a firm perspective, minimise. How do we minimise the impacts of Brexit? Because it is all about cost, little upside. From a regulatory perspective, we have a very different objective. Our gatekeeping role is hugely important. It's hugely important to make sure that the firms that operate in Ireland don't introduce unwarranted financial stability risks, don't cause problems from a market integrity perspective, and that the end consumer, the end user of those firms' products and services are protected. And we have a responsibility not just for the Irish citizen and the Irish state, but we also have a responsibility from a European perspective. In fact, those firms that will be coming to Ireland or changing their businesses in Ireland are doing so to set up effectively EU headquarters in a post-Brexit world. And so they need to have operations that are robust, suitable for the complexity of the work that they do, and that can meet our robust, our analytical, our outcomes-focused supervisory approach. And our approach then is driven by that, and trying to move the firms to recognize that there are asymmetries without getting into a negotiation, because that's not really where we want to be, and it's not our role, but to be very clear as to what our expectations are. It is meaning that we're having ourselves to make some very hard decisions. The head of the FCA was speaking earlier this week about the decisions and choices that are being made by the FCA in terms of their priorities. We're having to make exactly those same choices. So we have recruited, we've applied additional resource, increased the level of headcount we have within the bank, and reallocated within the bank those most senior experienced supervisors to deal with the authorization activity that we are seeing today. We're now having to make some choices about, well, what's less critical than Brexit that we can defer or stop doing for 6 to 12 months as we get through this authorization activity, which is an uncomfortable position to be, if I'm honest, but we're trying to make sure that we do that on a risk basis. Also touched on earlier was our approach from a European perspective. I'm delighted to hear the reference to the ESA opinions, the European, the insurance, the banking and the markets Brexit opinions, and the work of the SSM, so Banking Union. There's a huge push from us to get those done. Not just us, it was a pretty... The serious players within the European system were of one around this, but certainly at the start, immediately post the referendum, there was a risk of regulatory arbitrage. Very clear from our perspective that we were not going to lower our standards in Ireland, but we wanted to make sure that the decisions that were being made were based on the tax regime, the employment law. Whether you actually, a really good indicator is whether there was an operation in a particular jurisdiction or not already, not whether there was a favour or a wink or something from the regulator that actually will go easy on you. And that has risk definitely at the start. Risk is still there to an extent, but it's been very significantly mitigated. And from a banking perspective, I mean that's pretty hardwired through Banking Union. So I will then to come on to the transition arrangements in it with a bit more detail, because I think this is an important point, and I think there is a degree that of uncertainty as to the regulatory response to the transition arrangement. It's clear from my perspective, and it's interesting again that Neve's referred to this around nothing being agreed to everything is agreed, and I hadn't realised that it was quite so high up the consciousness in the UK, but that is absolutely the case. As I touched on, there is asymmetry here because the UK government has committed to put in this temporary licensing arrangement. So we have a pretty firm and the probable outcome that the transition agreement will be ratified. That's welcome. But in the UK, for the UK authorities' perspective, they have a backstop to that as well, which is even if it isn't, they will be able to cope. They will be able to deal with things from those inward firms from a UK perspective. That backstop isn't in place within the EU27. So we need to think about it in a different way. That's not to say that we ignore it, but we do still have a plausible downside scenario where the transition arrangement doesn't hold, it isn't ratified, and we need to deal with that on that basis. And so we need ourselves in the central bank to be prepared for that eventuality, because while we might hope for the best, it is our job to plan for the plausible worst. And we also need to be making sure that those firms that are operating here already can cope with that scenario, and those firms that are either changing or are incoming can cope. So what does that mean in practice? Well, there is a fundamental principle supervision or authorization around governance, control, resources, whether it's financial or human or operational, being commensurate with the nature, scale, and complexity of an operation of its business. That's not negotiable. And that's what we have to see on day one. So, right, if you can think about day one, at the point that we send the letter, or we authorize a firm, or we approve a material business change, that's the judgment that we're making, that those things are in place. But we would also recognize that Brexit-related changes are happening over a period, that businesses are being transferred, that there will be growth post that authorization decision. So that day one position is effectively a staging post, or can be a staging post, on the path to whatever the operational and organizational arrangements may be post either a transition arrangement or post-Brexit. And if we think about those operations, those arrangements post the transition or post the Brexit taking effect, we can think about that as, say, day two. And so how I'm thinking about this, and how we're thinking about it within the central bank, is that on a case-by-case basis, engaging with firms as they go through the supervisory authorization process, and indeed those firms that we have here today, that they can talk to us about, well, this is what we're going to look like on day one, this is what we plan to look like on day two, and this is our plan to get there. That's a perfectly reasonable approach. But what we also want to see is, if for whatever reason the transitional arrangement is not ratified and not agreed, how do you get from day one to day two in an accelerated period? What are the risks associated with that? How will you manage it? And so that's very much how we're thinking about it. And again, to go back to the asymmetries, because there's a backstop in the UK, those firms that are going from Ireland into the UK, the answer to that question about how do you get from day one to day two is going to be different from those firms that are coming from the UK into Ireland, or any other part of the EU. And so there is a bit of case by case in that, but I'd hope that we can be pretty clear about what our expectations are around that issue. I'll turn now to the regulatory framework and the impacts of Brexit on that. It's very, again, touched on earlier, it's very clear that Brexit has a material impact. There's a good discussion on equivalence. Equivalence from a financial regulation perspective is important, but equivalence in terms of other issues, and GDPR was mentioned, which is something that we've been looking at ourselves. So that is very important. If you listen to the political noises in the UK, there's definitely a degree of pressure around, well, there's potential opportunity for the UK economy, for UK businesses, to diverge from the EU standards. Now, the counter to that is the likes of the British CBI coming out yesterday saying very strongly that businesses don't want that divergence. But at the point of Brexit, the UK and the EU are going to be equivalent. They will never be more equivalent than they are on the point of Brexit. At any future point, there will be a degree of divergence. The question is how much and how quickly and in what way. But that divergence impacts on equivalence assessments. That equivalence assessments is something that's relatively fragile. Certainly is something that is subject to change. So it's not a basis for building a long-term plan for a UK company to be providing material services into the rest of the EU and vice versa. So there are very much limitations from an equivalence perspective. also touched on earlier, this loss of the UK voice in the European regulatory system, not talked about very much. I think it is a very serious problem. One of the dangers actually for the European system is that it becomes more inward focused, that it focuses on what it's doing within the EU. At the moment, it is a very international financial system, but post-Brexit, the most material part of it that's internationally focused is going to be outside the EU. So somehow the EU has to work a way to make sure that that connectivity with London, certainly in the medium term, and that outward focused ability to connect in with the global system isn't materially disrupted as a result of Brexit. From a regulatory perspective, the experience, the capability, the thinking that we get out of the UK regulatory authorities is off the pitch. That's a real pity. So it's a real pity. I would say that because that's where I cut my teeth. But I see it, and I think it's not. It wouldn't be just the Irish who would recognise that. So there is a need for within the EU system to rebuild that, to build that capability within our regulatory framework. It's an acute issue for Ireland, whether it's despite of or because of our long and troubled history. The philosophy from a regulatory perspective, and beyond that, when we get into kind of business and thinking about how economies work and the outcomes we're trying to achieve, the approach to regulation, we're pretty consistently of similar minds. That's not the same across the whole of the EU. There's some very different cultures, different backgrounds, different histories, different perspectives. And that is impacting already on the direction of travel for the European regulatory framework. That will have impacts for the Irish financial system. Some of them probably potentially quite negative. And the loss of the UK voice is going to be, over time, I think, quite acutely felt in Ireland, even if it's not realised that's what it is. And so our work within the central bank, we've been committed we're very much European. We've been committed to engaging and being influential in a European perspective, typically invisibly. So we see it within the bank. I don't think many outside the bank would see it. We've got to step up as well, continue to be effective, be more effective in that area. I will finish there. Just to summarise, what I think are the kind of key things that I'm thinking about at the moment. Brexit will have profoundly, largely negative effects for Ireland, certainly a hard or chaotic one. Those effects will be uneven. There is some upside for Ireland. The financial services sector will grow. It will become more complex. But overall, we would see downside risk from Brexit for Ireland. As I mentioned, I think it is really important that the EU financial system doesn't become insular, that it is really important that it continues to be a globally connected financial system, even, as I say, as the bit that makes it globally connected primarily will no longer be in the EU. Thirdly, we all need to be prepared for the challenges, very significant challenges that lie ahead of us. In my remarks, the published remarks, I refer to engagement we've recently had with the insurance industry, where we wrote out to those firms that are operating in Ireland, about 200 of them. 3/4 of them came back with a view that Brexit will have little to no impact on their business models. I frankly cannot believe that. So it is really important that industry participants, even end consumers, and my colleague Derval will talk about this in the coming weeks, need to be thinking about impacts around Brexit and preparing for what's coming down the tracks. And finally, just to say that the central bank has it's right up the top of our list of priorities. We are focused on Brexit. We're focused on ensuring that the risks around it are managed and mitigated to the extent that they can be, and that we are doing our job and doing it well. So I'll finish there. Congratulations once again to. Of course I will. Yeah. So congratulations to DCU for the setting up of the institute. I would, I guess, somewhat cheekily suggest that rather than Brexit, the work coming towards the end at the point of March 19, I think we are just beginning. Yeah.
Thank you very much. And we remind we're hopeful that Arthur Cox will renew their sponsorship beyond. It's so nicely set up. We have some time for questions. I know that the deputy spoke to a prepared script, but I'm sure you're happy to take some questions.
Yep.
So if people ask a question, if you introduce yourself beforehand. So thank you.
Sorry, Brian Cord.
Hi, Brian.
Thanks very much. Ed, obviously with banking union, there's a new process for authorizations of banks through competent authorities, yourselves, and the SSM as well. You might just talk a little bit about the practical experience of how that's been working, because there obviously hasn't been many cases of that over the last few years.
Okay, so just to frame my answer. So the SSM isn't something that sits in Frankfurt. The central bank is a very active member of the SSM, and so all that we do here, as part of all that the ECB, banking union does, we're involved in. And that's important generally. It's an important point generally, but it's also important in talking about authorizations. So we are dealing with things across the Eurozone, across the SSM issues, and having to make decisions that we haven't thought about necessarily very hard before. Whether it's, I think there was reference earlier to booking models, those kind of issues. We're making sure that in terms of the engagement we're having with those banks that are seeking authorization, that we are joined at the hip with our ECB colleagues, so that there isn't an approach of, well, you get it past the central bank and then you've got to get it past the ECB, or there isn't a case of us having to kind of guess or work out what do we think, and then the ECB works out what it thinks, and there being some dissonance between them. So that the approach is very much as you would expect with any authorization. There's a back and forth. There's making sure that there's a good understanding of what the business is going to look like. We've made sure that we have our strongest people in the room for that process. We've made sure that our ECB colleagues are coming along for the ride with us. And we've also made sure that in terms of getting information out into the public domain, that there's a Q&A up on the ECB website that has gone through the rigor of discussion at the supervisory board, that it's an agreed position for the SSM, and that we can all work to. And then, as we're dealing with what are pretty complex and large authorizations, we're taking the decision-making body through them as we're going through it. So we're updating the supervisory board, which I'm on, to make sure that when we get to an end point, there isn't a sudden surprise, or I certainly hope there isn't, of, well, actually, did you think about X, Y, or Z? Probably takes a little bit longer than it might do if it was entirely in the gift of one NCA. But the hard wiring of the avoidance of regulatory arbitrage, I think is well worth that.
Stijn Beideveld from the Netherlands Embassy. Thank you very much for your very insightful speech. At the end, you made a remark about the importance that the EU financial system stays a global system, although London as a global hub will leave the EU. How do you see that being possible in the long term? What should happen when we only have a system of equivalence with other systems outside of the EU? That the EU system still stays a global system instead of a more regional one? Thank you.
Right. Okay. Well, that's an easy question to answer. I think first and foremost, I think we have to set ourselves up in a reasonable way. So, and that I would say is it's an easy to use word, but to focus on being pragmatic. So when we're engaging with firms that are making operational decisions to relocate aspects of their business, is to think pragmatically about how their interaction and interlinkages with London will continue, and what do we need in order for us to get comfortable that that's appropriate? How does that linkage remain, so that there is still an ability for those firms to have flow going, kind of funding to flow through their businesses in an effective way. So we're not ring fencing within the EU versus outside. Over time, I think capability will be built within the EU, and I think that the diagnosis is right. The immediate impact on the UK financial system and London will be relatively small, not insignificant, but relatively small. But over time, as firms are making decisions as to how they build capability, where they build their capability, I think different decisions will be being made as a result of Brexit. So the capability within the EU and the infrastructure within the EU outside of the UK will continue, somewhat zero-sum, will start to build at the expense of London. A lot of this already works reasonably well, and I mean there are big financial services firms within the EU already, or often out of London, but not exclusively. And the engagements with the US and Inter-Asia and how that plumbing works, and with the Swiss indeed, it works okay, but it is a seismic shock to the system, so we will need to think hard about it. And whether it requires legislation or not, which again was touched on earlier, what needs to happen to make capital markets union effective, what needs to happen to make the banking union effective, even bringing in thinking a little bit around fintech, what happens there. All need to but it needs to be thought of in an outward as well as an inward perspective. But there are no easy answers. That's probably the best I can do. But I'd certainly happily take some assistance from the previous panel.
We have a gentleman at the back and then a gentleman here.
Kevin Wall from Barclays. Just actually related to the first question, we are seeking authorization for an expanded entity here, and I can just sort of, sitting on the other side of the table to Ed and his colleagues, as it were, just endorse that how he described it is exactly how it's working. Ed, my question, in terms of the politics at the Commission level and how that plays a part in terms of the way that the regulatory and the supervisory environment is evolving, any observations?
I'm probably a bit late, as you probably asked that question better of the first speaker today. Honestly, it's something I try and stay away from a little, although it would be naive to think I could stay away from it altogether. I think it does come down to this asymmetries point. So from a Commission perspective, we are in a negotiation. And there's a degree of, well, who's going to blink first? And that's not just from a from a UK EU 27 perspective, but it's also from a firm perspective. So if we take the issue of contract continuity, the Commission perspective, I think, would be, well, it's probably time for firms to sort that out. It also, if you look at the data, is less of an issue for the EU than it is for the UK. So while the UK and the Bank of England and the PRA have come out very strongly around contract continuity, particularly from a derivatives perspective, the Commission has thought, well, actually, it's, sorry, Alan, this is a personal view, it's not such a big deal for the EU. And also, if we give ground now and say we're going to do something about it, then at the point that something has to be done, it's a much bigger problem than if firms think there isn't going to be a fix here. So I think it's all part of, there's a lot in that question, there's a lot in the mix there. I would see the Commission at the various European forums that I go to, but and I think it's right from a separation perspective, engage directly. But I think you can think about it from an asymmetry perspective.
Peter Flanagan, Bloomberg News. You talked about the potential loss of UK regulatory expertise in your speech. Is there a concern that could lead to kind of weaker regulation within the EU overall in the short term, or is that something that isn't realistic at this stage?
Certainly in the short term, I don't think that's a risk. And I agree with Niamh here that there is a degree, I think, now of stability. I think that the major kind of regulatory overhaul from a post-crisis perspective is largely complete. I mean, there will still continue to be evolution of it, but the kind of the radical changes, I think, are largely complete. It's more, I think, probably there's a degree of pragmatism in the UK based on experience that they have as being responsible for a global financial centre, and the degree of expertise that they have in how that's executed. And also, as I said, generally speaking, from an Irish perspective, philosophically broadly aligned in many respects.
Ed, hi, Bob Quinn is my name. I run a business called the Money Advisors down in Naas. I suppose I want to start off from the get-go to say that for those of us in the B2C space, the central bank has a very effective social media platform. It's active on Twitter. Publishing the central bank commission minutes is a very useful thing. So there is certainly a degree of transparency that is there today that wasn't necessarily there not so many years ago. I have a couple of questions though in relation to, you mentioned passporting, you mentioned about financial shocks attached to Brexit and all that. It's been well published that the likes of credit unions and take the likes of Permanent TSB has a wholly unacceptable level of mortgage arrears and the implications that has for individuals and families. So I have a couple of questions. Number one, given the fact that Brexit is imminent and if worst case scenario is realised, there's going to be a number of credit unions that will simply go bust. That's the long and the short of it. There are people that are going to get stuck with a high level of mortgage arrears, the difficulty that'll have in permanent TSB is another thing. Moving on from that then, in relation to passporting, I want to look at, quite frankly, the opposite of passporting. Meaning, can I get on a plane to France or Germany or Holland and go to KBC Belgium, for instance, and take out a mortgage on my property in Naas? Right now I can't. So there is issues with standardization across European countries. So for instance, when it comes along to the central bank launching the central credit register recently, that to my understanding has been done on an isolation basis. It hasn't been done with 27 other European Union members. It's been done simply, this is what's acceptable in Ireland. So when it comes along to taking advantage of the single market and going out there and getting a mortgage of 1.7% instead of 3.7%, what is being done at a Central Bank of Ireland level to coordinate and work with your European regulators to open up that single market for all of us? And I suppose, you know, a few other things. It's
Stop you there, we'll just take some of these questions and then maybe we'll come back.
There's a lot in that. Not all of it directly Brexit related, but I will attempt to address some of it. So from a credit union perspective, we have ourselves within the central bank, and also with credit to the sector itself, worked very hard over the last few years to build greater financial strength, greater resilience into the sector. That has involved a large number of mergers to address weaknesses in some credit unions. So the number of credit unions in the system has reduced from about 400 to just under 300 at this stage. And I am certainly more confident than I was that there is a great deal more resilience in the sector, and they're able to will be able to deal with negative shocks. From a mortgage arrears perspective, again, and it's well publicised. Indeed, we issued a report on this week. We have done a lot of work to try and address the problem and to make sure that those individuals, those people that have been, and I use the word distressed deliberately, are in distressed positions, have the ability to, through engagement with their banks, to be restructured in a way that enables them to stay in their homes and meet the terms of their mortgages. Now, having said that, if you look at a system that's got 120,000 restructured mortgages in it, with a very high dependency on variable rate mortgages, there is a clear vulnerability there to negative economic shocks, including interest rate rises. But we have ensured that there is a very high degree of protection for mortgage holders. But that's not to say that the problem is fixed, as is clearly the case and as we've clearly identified and reported on this week. In terms of your comment on interest rates and ability to get a mortgage from KBC Belgium or wherever it might be, one of the issues that we see from a European perspective is that there is still work to be done from banking union. And there has actually been a lack of, to date, of consolidation across the European system. And certainly immediately after the crisis, the reverse was true. So banks and other firms typically withdrew from being internationally active into their domestic market. So there's been less international and European-based business than there was previously. But the barriers there are very low. So if there was a Belgium or a Spanish or a firm that wants to offer mortgages in Ireland, it can do so through a freedom of services or freedom of establishment, so the passporting route, by notifying, just simply by notifying us. So they work with our home regulator and notify us. So the question then is, why isn't that happening? Why? I know it's not without controversy in terms of cost of insurance in Ireland, but what we see in Ireland from an insurance perspective, with very high levels of internationally active firms providing insurance in and providing insurance out of Ireland, we don't see that from a retail domestic market. And there are questions, you have to ask questions as to why that is the case, because there aren't barriers there, and that's because there are some structural issues still in the Irish system, I think, and one of those is the mortgage arrears case that make actually potentially Ireland less attractive to write business in at the moment. We're certainly working very hard to make sure that to address that issue.
Thank you. Any more questions from the floor? Okay, Federico, will I call on you to draw the day to a conclusion, or will I thank Ed on behalf of the DCU Brexit Institute and everybody here? We've had a wonderful afternoon, very stimulating. a very wide range of opinions on this side, but certainly strong opinions from the floor as well. So we're very grateful to you. And again, just to reiterate our thanks to Messrs. Cox and GSK Stockamnn for today. So thank you very much.